Hello, everybody. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I'm back to talk about our stock market investment strategy utilizing closed-end funds. So, to get the normal disclaimers out of the way, it's an unedited video. Who knows what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a financial strategist, and I don't talk like the herd. I walk in limited company, and sometimes I walk alone. So, the update on my end of things. It was a fun-filled week. It was a busy week last week. Got a lot of work done. Still have a lot of work to do. Scholarship book is in progress, and honestly, it's sorry. I'm watching my cat be a cat. Um, let's see. Scholarship work. Scholarship book is a work in progress. Uh, Really, it's getting through the weekly to-do list. It's gaining ground every week, but also there's still more work to do. Um, I am battling, I don't know, the fallout of the most recent cold front sweeping the southeast. So I've got drainage and a sore throat. So if you see me drinking tea during throughout the video, that's why. And I would use my cup, but my cup is dirty, so it's a pink cup for my wife's cup. So the update for this week, I've heard whispers of a recession, but it just doesn't line up. I mean, I really spent my car ride yesterday talking this through with myself, and then it carried on uh, my daughter's Saturday event. Just walking around and thinking about how somebody would imagine the U.S. in a recession. So I'll kind of walk through my thinking with you. The old definition of a recession was more than two consecutive drops in GDP, and that's since been modified, but that's the standard definition. And yes, that is my cat. Uh, but we haven't had drops in GDP. And inflation, if we take inflation into account, inflation is almost a thing of the past. Now, even if the Federal Reserve came out and said we have 0% inflation, I still think we see devaluation every single year. The Federal Reserve's mark is 2%. I think that's bullshit. They could come out and say we're at zero. But at the same time, I still think we have some sort of inflation every year. So, yes, inflation is almost a thing of the past in the sense of inflation is far better than what the Fed is telling us. But at the same time, they're not doing their jobs. The United States is taking in crazy amounts of tariff money. We're not exactly printing money like we should. Well, maybe not like we should. We had been doing. We're currently in quantitative tightening mode. So in theory, we're not printing money like we had been doing. We're taking in tons of tariff money and enough tariff money to hype sending dividend payments to every US citizen and also paying off the national debt. And I think if, I mean, quite honestly, that gives me a lot of hope because I don't see Congress agreeing at any point for a balanced budget. And I don't see them agreeing to pay off the national debt because they are much better at spending everybody else's money than solving a problem long term. So if tariff money through the External Revenue Service really did pay off the overall national debt and eliminate taxes for you and me and send us dividend payments, if you think about it, if you really stop and think about it, we're not just taking in crazy amounts of money, we're taking in a shitload of money. The trouble is, the Fed knows this and they're not lowering rates because honestly, it's like blah, 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 blah. And they bleat worse than sheep. I mean, they'll tell you any number of things. Jerome Powell's days are numbered. He's the leaving chair, and he doesn't seem to be leaving in any better position than where we currently are. Current Fed trajectory is to pause rates. They're holding on another rate cut, to be honest. And the new Fed chair, we're hopeful of a rate cut. So at worst, we'll see things pause, and at best, we get more cuts this year. That's better than rates going up, but we're still back to the Fed being on the long end of the curve, or late to the party. So if GDP is rising and inflation is falling, what else is there? Like, why else would somebody think that we are headed for a recession? Well, jobs tend to influence recession talks, but the jobs market is stable. At least the underlying current of the market is stable. Excuse me. The changes we're seeing in the job market are triangulated in policy. One, AI isn't stealing jobs. It's eliminating the need for certain jobs or maybe additional jobs, and it's increasing the efficiency and decreasing the need for humans. Two, illegal immigrants are being shipped out of the US. Now, those illegals aren't on any official jobs board. Instead, corporations hired illegals under the table. So they hired them for less wages than a US citizen, and also essentially created a ghost job, like a job that in and of itself is undocumented. It's being filled and being operated, but nobody knows. So with the US exporting illegals, and that's freeing up all those non-existent jobs or those ghost jobs, many of those jobs aren't something that AI can innovate. So we've got some space in the job market, or do we? We've always got more people entering the workforce, especially timing. I mean, we're in the kind of like in the third part. So if we look at the calendar like a school year, you just had Christmas break, you'll see some December graduations. And now we're maybe 4 to 6 weeks into the next semester, pending your calendar. So we're about maybe a third, almost a third of the year in. About the halfway point, you'll see some other graduations. And in May, we'll see some more graduations. And at the end of summer, you'll see some more graduations. So there's always more people entering the workforce. That doesn't even count the people that are coming to the US legally. So we're not seeing a huge lag or experiencing a vacuum scenario. Instead, the economy and companies and jobs just chug along, filling spots where able and innovating as much as possible. So I honestly don't understand the recession talk. It doesn't make sense. I think it's much more herd talk and much more herd fear, like the AI bubble fears. So, sure, some AI companies are overvalued. It's always that way. The big five are always the big five, and they're always going to be worth more than what they really are because people just buy them. And yes, they get sunk in, or they sink into the age old, I won't say myth, but it really is bad advice. And you can apply it to any of them. But what I hear is buy Apple because it'll be worth more in 10 years, or it'll be worth 10% more in 5 years. Okay, well, that's 2% growth a year. Inflation, I think, is more like 3 or 4% a year. Even when inflation is zero, inflation is still 3 to 4% a year. So now you're behind your year's growth at 2% growth. Two, they don't pay a dividend. So even though it's going to be, worth more in 5 years, you're actually behind what it should be. Or at least it's worth more, but you've actually been over devalued. So it's actually worth less over the same time frame. Um, So yeah, I mean, my whole point is those top five, top seven, top 10 companies are always going to be bought because people buy them. So that means they're always going to be overvalued because people buy them regardless of what the market's doing. But that doesn't mean the entire market's overvalued. But I still don't understand the fear of an AI bubble. I just don't see it. We are at the forefront of the next golden age of technology. So on the on the up escalator, we're at the bottom, and like that escalator, yeah, you plateau a little bit here and there, but we are on the up escalator. I don't see a bubble. I don't see a bubble to fear, and I certainly don't see a recession to fear. So where does that leave us? Really, it's the same places. It's still bonds and bonds proxies, end-to-end energy and technology beyond the giants, or beyond the overvalued. So if we're looking at potential rate cuts, even with uh, plateaued rate cuts or the hope of another rate cut, bonds and bonds proxies are great. End-to-end energy, because technology feasts, like gorges itself on energy. It takes energy to make all of that stuff, and it takes energy to supply all of it. And then technology beyond the giants. So most people think of most people when they hear AI, they think ChatGPT or Grok, or maybe there's another AI engine they use, Copilot, Google, DuckDuckGo, like whatever you're running. So pending your AI bot or your AI chat, yes, that's AI, but there's so much more to it than just that. And we are just forever evolving. It's back to the dawn of the internet, where if you bought technology one day, it was already outdated the next. And that's kind of where we're going with technology and AI right now. So those big guys, yes, you're going to see scale there. You're going to see growth. But we want to look past that middle to say small business to mid-level business. They're going to see a ton of growth and a ton of profit. So where does that impact us on the closed-end fund side of things? So as I've said in previous videos, with my desire to really bifurcate or really prioritize a membership group, even though I don't have the membership group right now, I'm going to start doing the full sifting of the list in membership and show you like a top five, or maybe like a handful of top picks here. So if I was investing tomorrow, if I was buying tomorrow, this is what I would target. Now, I can't buy all of it. I have a limited budget. And I don't know about you, but if I was buying tomorrow, I'll at least tell you what I would be buying tomorrow. So let me share my screen. So I sifted the list. I looked at every closed end fund with a significant discount, and then I sifted based on monthly payment. I sifted based on overall yield, and then I sifted based on price. And the goal was $16 or less. Generally, I prefer a monthly payer, but for right now, USA and ASG are on the list. So this is a top seven, I think, top six, but we're going to cut it down. So I like buying specific funds in pairs or in sets. I like buying BRW and FSCO together. I like buying USA and ASG together. And I mean, y'all know me. If you don't know me, I love monthly pairs, quarterly pairs. Like if it's the best deal compared to everything else, fine. But it, I like monthly income. I like consistent monthly income. So it's really hard to wait for quarterly checks or quarterly dividends, however you want to say it. So for USA and ASG, Yes, they're quarterly payers. Yes, they're both on significant discounts. They meet the 9% threshold. They're great as a tag team. Currently, they're a dollar cost average deal for us, but they both recently hit ex dividend at the end of January for the March dividend. So if you buy it today, or if you buy it Monday, you're not going to see a dividend until June. And even though it's a great deal, like even though the discount is great, even though the price is great, and they still pay a great yield, that's a really long time to wait. Like you're essentially waiting 4 months to see a dividend, and that's just not ideal. So they're great buys, but it's hard for me to leave them on my list. So that brings me down to four. So I like buying these in sets. Then it comes down to what you really have and what you want to spend. And I'm not telling you to buy these things. I'm not um, let's see, I'm not telling you, I'm not advising you to buy these. This is if I bought tomorrow, this is what I would buy. I would buy BRW and FSCO as a set. So I would buy 100 of each. That meets my collection of dividends, gives me a little padding at the end to carry over to the next round. The other thing that's tempting. So if we look at essentially looking at the combined dividend yield, so to buy 100 of each and buy them both, that's about 15.28 in uh, dividends a month. The next alternative would be to buy 100 shares of HGLB, mostly because their portfolio is like a third of it is in the mid-wave wireless. About a tenth of it right now is in data centers, and then they've got other investments. But the data center investment is interesting to me. So I can pick up 100 shares of that. I can't pick up 200 because it pushes me past my point. I could pick up 150. I like sets of 10. I really like 50s, and I really like sets of 50 and 100. I generally don't buy sets of 50 because I just got, honestly, I just got used to buying sets of 100 because it was easier on the math. But I could pick up 150. I have that. We'll just say it's 100. And then I would carry that money forward into the next month. And then NBXG is all stocks. Now it's all 5G stocks. It's all stocks that would profit from this expanding technology and AI universe. But I also like it because here, you can pause the screen and read all this stuff. I also like it because they sell covered calls. And in a very volatile market, it's just a good strategy. It um yeah, with the up and down of the market, it it's always I can't what I'm trying to think of a word. I'm drawing a blank on a word, so forgive me. But DX, let's see. Volatility. There we go. So strange to draw a blank on a word. In a very volatile market, the up and down of the market, covered call funds profit off the volatility. So I like their company setup. I like the funds they have. I like their payout. Um, Currently, it's not a dollar cost buy for us. I don't think 1438. And yes, this is our actual portfolio. No, it's not a dollar cost buy, but it is still a good buy based on their history. So those are my four: BRW, bonds, CEFs, crypto, FCO, which is it's an all US bond company, but it's really a BDC. HGLB, yeah, not so much the bond, like they've got the bond and bond proxy layout, but it's really the midwave wireless and the data centers, and then NBXG. for the portfolio they have and the covered calls. It just depends on how you want to play it, to be honest. The best dividend outcome is the top two. HGLB has the data centers. NBXG is all stocks and all tech favored stocks. So it really just depends on your goals and your portfolio and where you think the market's going to go. So that's honestly really quick compared to my normal videos, but I think that's a good thing. So let's see. Let me know what you think in the comments. Let me know if you like the new video style. Let me know what funds you're interested in. Let me know where you think the market's going. Let me know if you disagree with my top four. And let's see what else. I will keep you posted on things on my end of the spectrum. I'll keep you posted on the book updates and what I plan to do from there. And as for the video, that's all I have today. So see you next weekend. Have a great week. And hopefully you're not getting dogged by the same allergy stuff that I have um, or anything else for that matter. So let's see where's my video? There we go. So have a great week, everybody. By all means, give me constructive feedback, and I will see y'all on another video. Bye bye.